Hello guys, this is the credit module. So some of this should be pretty familiar since we talked about borrowing money before. And so the big things that we're going to end up talking about today, how student loans work, how credit cards work, how mortgages and home loans work. Those are the same thing. I don't know why I put that. And then how do credit scores work. So student loans, that's probably where we first need to start because this is going to be the first thing that really probably most important to you guys. So your senior year of high school, seniors, hopefully you've already done this. You have to complete your FAFSA, okay, free application for student aid, for federal student aid. Now with this, once that money goes to your school, the school will offer you a financial aid package, scholarships, grants, student loans, things like that. Okay, you want the scholarships and grants because you don't have to pay those back. But obviously, you're probably not going to get all school paid for. So the rest you take out with student loans. Now, here's the thing with a loan. All loans have interest payments on them. And that interest payment compounds. Okay? Now, if you have unsubsidized loans, okay, that means that they start compounding the first day of the school year and then all the way through your time through school. So that loan from your freshman year is compounding interest for 4 years while you're in school. Okay? If you have a subsidized loan, the interest does not start until you graduate. Okay? You do not owe any money while you were in school. However, if you got extra cash laying around, it would not be a bad idea to try and pay off some of that interest payments. Okay? Now, 6 months after graduation, you have to begin payments. You have 10 years to pay them off. The interest rates are 4.53% currently. So that's a pretty high interest rate. And if you have a lot of student loan debt, it's going to take a lot of money to pay off. And I'm going to have a student loan calculator for you in the links on here so you can kind of see. I will say this, try to avoid private company loans if possible. Try and stay with the federal government ones. The federal government ones have a different payment options paying off, a little bit more flexible than the private loans. Obviously, if you have to get private loans, you have to get private loans. But I'd try and stick with the federal ones if you can. Now, the general rule here with student loans is this. Do not take out more in loans than you expect to make your first year working. So go and look how much money for a first year your job makes. If you're going to end up taking more out in student loans, then you're going to put yourself in a really, really tough shape financially. My example is this. Don't go to Harvard to become a public school teacher. Okay? I knew obviously that about what my income would be. And I knew that if I went to some university that's $60,000, $70,000 a year, I'm never going to pay those loans off, right? And that's why I chose to go to a public university. Okay, so that's something to really keep in mind when you're thinking about colleges. Is hey, does this college tuition make sense for me for the career I'm going to end up working? Okay. And again, there'll be more student loan stuff in our module. How do credit cards work? Okay. So credit cards are loans from the bank. Okay, when you swipe a credit card, what you're doing is you're actually taking a loan out. The bank is covering that payment for the company that you're buying something from, but then you got to pay the bank back. So the bank has a credit limit, usually like 8,000, 10,000, whatever. As long as your card balance stays under that, you're good. Okay, you can keep using that card. Now, you do not have to pay the entire balance off at the end of the month when the bill comes. You only have to make the minimum payment. Now, the minimum payment is usually a pretty low chunk, and you might be paying back that purchase for a long time, only making the minimum. If you do not pay the entire balance off, you will begin being charged interest, and the interest is very high. It makes it hard to pay off. My suggestion with credit cards, what I use mine for, I spend all mine, and at the end of the month, I pay it all off. Okay? I've never once carried a balance over. Not saying I ever will. I mean, sometimes you might have to. You might have to make some huge payment or something. But for the most part, I pay it off that month. If I don't have the money to spend it, I don't spend. Okay? And that way, I've never been charged interest on my credit card before. Just to show you that visualization, let's say you spent $5,286 on your credit card. They're going to tell you the minimum payment's only $52. Okay? If you make that 52 payment, nothing bad will happen to you, right? They're not going to yell at you. You're not going to get sent to collections, anything like that. However, you're going to be paying off that month's balance for 23 years. And you end up paying back $11,000 on a $5,000 purchase. Okay? So my advice is don't spend the $5,000 if you can't just pay it in cash, right? Pay off the whole balance each month and boom, get out of there. You are able to save a ton of money by doing that. From there, we're moving to now bigger, more expensive loans, mortgages, and cars. Okay, these you have to apply for. So you actually have to apply through the bank to get these loans. Basically, the bank will analyze your credit history, your income, your savings. They'll determine if they think you're able to pay the loan back, and they'll give you the loan. Banks will require you to make a down payment, so they will not give you the full amount for the loan. For a house, it might be 10% or 5% or 20%. Right? So if it's 10% and you want to buy a $100,000 house, that means that they're only going to give you a loan for $90,000. You got to pay the other $10,000. Now, the key with these types of loans, these are secured loans, meaning that from the bank's perspective, if you do not pay the loan off, the bank will seize the property and they will sell the property to try and get some of their money back. Okay? Just to show you the down payment on a house, kind of where most people are, you can see that most Americans make somewhere in the 10 to 20% down range in buying a house. Cars are a little bit trickier because some car dealerships will let you get away with no money down. That almost never happens with a bank. Usually with a bank, you got to put at least something down. But again, you'd probably want more in the 10 to 20% range would be, to get the loan, okay? Now, when the bank analyzes your credit, they're going to primarily use your credit score. So they're going to look at your credit history, and that is calculated in a score. And you want that score to be higher rather than lower. It's a measurement of how trustworthy you are as a borrower. So the better your credit score means the cheaper of a loan that you get. Okay, so when you look at our credit score factors here, so your payment history is the most important thing. Don't be late on your payments on anything. Okay, your credit card bill, your student loan bill, pay on time. Your amounts owed, super important as well, right? If you have a crap load of debt that you still owe, the bank is less likely to give you that amount. The length of your credit history, obviously, the longer of a borrower you've been, the more likely you are to be trustworthy. Your new credit, okay, if you've been borrowing a lot of money recently, banks don't like to see that. Okay, and then your types of credit used. They like to see a wide mix of student loans and auto loan and credit cards. They don't like to just see you only have one loan that you've taken out. They like to have you have a built-up credit over time. So the number one factor is pay all your bills on time and you'll be fine. Okay, and with that, you'll get good credit, and the better your credit score, the cheaper the loan you're going to get. The less interest you're going to pay, the better loans you're going to get. The bank is more likely to loan you out stuff. All right, that was credit. There's going to be a lot of more stuff in the modules. So, all right, see you guys.